And in case you don't know me, my name is Catherine Harrington. I am the very proud president and CEO of the West Des Moines Chamber of Commerce, and we want to thank you so much for attending the Economic Update event today featuring Bob Baur. And this is presented by DG Medical Developers and supporting sponsor Unite Private Networks. And also a big shout out to Principal Midwest Business Center for helping support this through our partnership and bringing Bob to us today. I know he's going to be super insightful. We just talked a little bit on the virtual backstage, and he said he's just going to talk about the positive parts of the economy. So I love that. Let's see if he sticks to that. So this event could not come at a better time. Our state's unemployment rate is at 6%, and that's compared to 2.8% just a year ago. We all know that COVID has rocked our worlds. However, we at the Chamber are working very, very hard to support our city and region during this critical time and try to do all we can to help continue moving West Des Moines forward and keeping our community strong. Now, what this includes for us personally is over 10 plus new initiatives that help our members build new connections, awareness, buzz, and sales. Our team is tremendously proud as well of our groundbreaking Diversity, Equity, and Inclusion Committee led by the amazing Angela Jackson. And this helps to support our underserved populations. And you know what? We are just getting started. We just announced this week that we have a new committee that is being formed by Therese Wielagi. It's called Explore West Des Moines. And this is with the effort of hosting and attracting more events in our backyard, which will have an economic spillover effect for our area restaurants, retail, hotels, and will be a workforce attraction mechanism for professionals and businesses alike. So I am now happy to introduce the expert chamber team that includes, everybody give a wave, Kara Matheson, who is our Director of Workforce Development. And we are proud to say that the West Des Moines Leadership Academy 14th year is in full swing as we speak. Anna Dowd, Director of Membership and Strategic Partnerships. And our exciting fall membership drive is well underway. Nicole Langmaid, Accounting and Administrative Specialist, and watch for a survey in December asking you about your ideas for insightful programming for next year. And Bailey First, who is running our program today. She's our Events and Marketing Communications Manager, and she encourages everybody to vote today and tomorrow by noon for the first annual US Cellular Best of the West Awards. So here we go. I'd like to bring up to the virtual podium Bailey First, who's going to tell us a little bit more about our event today.
Yeah, thank you, Catherine. Hi, everyone, and thanks for joining us today for our 2020 Economic Summit. I just wanted to remind everyone to keep your mics muted throughout the program, but please utilize the chat box to drop any questions as they come. After I'm done speaking, Anna Dowd, our Director of Membership and Strategic Partnerships, will introduce our sponsors, DG Medical Developers and Unite Private Networks. Thank you to both of them for making today possible. Then the person you've all come here to see today, Bob Baur, will begin his presentation. Afterwards, we have time for a lengthy Q&A because I'm sure there'll be lots of questions. So again, make sure you're dropping those questions in the chat box. And wave, because everyone is being recorded right now. The link to this will be sent out afterwards within the next 24 hours. So now take it away, Anna.
Awesome. Well, thank you so much, Bailey. And a big thank you to all of our sponsors who are here today with us. Without your support, these type of events wouldn't be possible. So thank you so much. So we would first like to extend a big thank you to Unite Private Networks as our supporting sponsor for today. So with us, representing them is Mike Kelly. So Mike, I will hand the virtual podium over to you.
Thank you, Anna. First off, we'd like to thank the West Des Moines Chamber for allowing UPN to be part of this really great event. We're excited about it. UPN provides high bandwidth, fiber-based communication networks and related services to schools, business customers, hospitals, carriers, data centers throughout the United States. Our service offerings include dark fiber and lit fiber, private line, optical Ethernet, internet access, data centers, voice, and other customized solutions. We currently serve over 300 communities across 21 states. In Iowa, UPN has been serving enterprise business customers since 2016. We provide connectivity to Iowa businesses in Des Moines, the Des Moines Metro, Ames, Waterloo, Cedar Falls, Cedar Rapids, Iowa City, many other communities throughout the state. There are over 1,300 miles of UPN fiber in Iowa that serves more than 16,000 on-net and near-net buildings. Iowa is a major focus for UPN in 2021 and will be investing millions of dollars in additional infrastructure to expand our network reach. That being said, that's the big commercial for UPN. Thank you for letting us be a sponsor, and we look forward to hearing from Bob.
Awesome. Thanks so much, Mike. And thank you again to Unite Private Networks for helping support this programming. So next, we would like to give a big shout out and thank you to DG Medical Developers as our presenting sponsor. And today we are lucky to have Eric Torgerson with us. So Eric, I will hand it over to you.
Hi, I'm Eric Torgerson. I also have Gordy Bruinsma with me, and he is the G of DG Developers, and he's going to tell you a little bit about us.
Hi, good morning. Thank you again for letting us be part of this great event. DG Medical Developers is a healthcare consulting firm that's owned by myself, Gordy Bruinsma, and Dennis Frischmeyer, who is also one of the owners of DCI Group in downtown Des Moines. Together, we have a team that go out and do a lot of medical projects around the country, primarily focusing in on surgery centers, urgent care centers, as well as imaging centers. We have done a number of projects in the Des Moines market, with Dennis being headquartered here and Eric being here as well. I live in Michigan, so we have a national presence, primarily though in the Midwest. We have developed locally here probably 15 medical projects. A lot of the Mercy clinics have been developed by us, Doctors Now, as well as we're working on Unity Point and a new project in Guthrie County. We're excited to be part of this, and we just ask that you will consider us and getting in contact with Eric to talk about how you can invest or bring us any new leads for business in the future. Thank you.
So I have the honor of introducing Mr. Bob Baur. In his role, policy and strategy, oversees and conducts macroeconomics and quantitative research, forecasts economic trends, and anticipates market movements, and advises the investment staff in making economically sound investment decisions. He has numerous speaking engagements in the US and around the world, frequently quoted by the financial news media. Baur appears regularly on CNBC and Bloomberg TV. But basically, he's just a Madison County farm boy trying to make a living. Bob, it's on you.
Thank you very much, Eric. Appreciate that nice introduction. Thank you very much, Catherine, for the opportunity to speak to your lovely group. It's a pleasure for me to be with you all today. Good morning. Appreciate the West Des Moines Chamber giving the opportunity to chat with you. I got 4 topics I'd like to talk about today. First, I'd like to talk about the recent virus activity. Secondly, I'd like to mention what I think that means for the economic recovery that's going on in the US and around the world from the COVID recession of a few months ago. Third, I'd like to, using those two things as kind of parameters, I'd like to describe what I think that suggests, not only for the election, but for what I think the economy might be, or what the response might be to different election scenarios. And we'll look at what financial markets might do with one of 3 election scenarios. Last, I'd like to follow that up with an examination of what I think are some long-term global trends that are not going to change, with the election. And we'll look at what that might mean, what those global trends might mean for financial markets, and how the investment climate over the long term, the rest of this decade, may change a bit. So let's start with the first topic, which is virus activity. And that's very important because it certainly has an impact on the economy. And I'm sure you all know in the headlines, the US, if we look at daily new cases of the virus, they've been rising again. Yesterday, the 7-day moving average across the United States was 59,000 new cases. That's up from a high of 34,000, up a lot really on September 12th, but it's still below, at least a little bit below the all-time high of about 67,000 on July 23rd. Fortunately, fatalities are not rising a lot with that, nor are hospitalizations, at least rising a lot. And the use of ICU beds for COVID patients is also not rising a lot. The 7-day moving average of new fatalities is 757. That was yesterday. That's been a little bit up over the last several weeks, but it's quite a bit below the recent high of 1142 on August 1st. Current hotspots around the US are more in the middle of the country and north, in particular, Colorado, north South Dakota, Montana, Wyoming, Minnesota, Iowa, Illinois. A couple of things here for the virus. Either the virus is just slow to get to some of these states, and with the US, it's a very big area, and that's quite possible. The negative alternative here is that this may be the onset of the virus cold weather flu season, and if that's the case, that's not good. Globally, cases are really surging in Europe. We have record cases in many countries. France, Spain, Italy, Austria, Denmark, record cases also in Germany. About the only case where, the only country where cases aren't record is in Sweden. And you may recall that they handled the virus differently. They did not lock down the country, so their economy didn't go down quite as much. But they kind of allowed people to do their to do what they thought was best. There are record cases now in Russia, which makes you question the validity of the vaccine that they supposedly came out with a while back. If you look at India and Indonesia, those are they've seen a peak in cases also. If you look at China, the most recent outbreak in China was 13 people in the city of Qingdao. And what officials did in response to that, of course, was they, at least the story goes, they tested 11 million people in 5 days. They found Ripley's, believe it or not. I think this shows, at least in the developed countries, how that lockdowns really don't prevent too much. They more postpone infections ways. They also, I think it shows that the virus is simply very resilient, and we're just going to have to learn to live with it. I think partly we're winning a little bit. We have better treatments, and we hope to see a vaccine coming before very long. Now, let's go on to topic number two, and ask what this means for the economy. Well, the virus may be resilient, as we said, but so is the U.S. economy. We had the recession began in March, but it likely only lasted a month or two because we had a huge, fast rebound in May and June. Growth did slow a bit in July as cases mounted, but we've seen robust growth here in August, September, and it continues in October. Just some of the data, housing is just spectacular. We've seen home builder confidence now at record levels for the second month in a row. I mean, if you're interested in some of the details, data details, feel free to ask. Capital spending is indeed rebounding. New orders for core capital goods are now above a year ago. Plans for capital spending are quite robust. If we look at jobless claims, look at continuing jobless claims, meaning the people that continue to get jobless compensation. They were 22.8 million on May 8th. Now they're about 8 million a couple of weeks ago, and they dropped by 4 million just in the month of September. Look in September, total retail sales are now well above a year ago. They surged in the third quarter at a 50 to 60% annual rate. If you look at regional Federal Reserve Bank surveys, Philadelphia, New York, for example, those are the most recent ones in October, those are very strong. If you look at small business confidence, the National Federation of Independent Businesses, their confidence survey is now back into pre-COVID range. And maybe one of the best data points there is that the companies that report their inventories too low are a record high. So that suggests that inventory accumulation is going to continue to provide push economic growth here in the fourth quarter and into next year. If we look at the most recent data coming out for the third quarter, if we look at gross domestic product, it'll come out next week, I think. That should show a huge rise of 25 to 30% annualized gain. So the U.S. is clearly on a path, I believe, to a sustainable recovery. Looking ahead, we believe that this robust growth will continue into the fourth quarter. We look for maybe 5 to 8% annualized growth in the first quarter. In the fourth quarter. Now, the first quarter next year could be a little question because that's really the height of the flu season. As we look ahead, we think 2021 in total could still be a little bit of a question because absent a vaccine, we think growth will revert more to trend about 2.5% because many of those temporary layoffs and temporary business closures are for sure, some of them anyway, are going to turn permanent. But if we do assume we get a vaccine, as I think probably is likely toward the first of the year, we'll likely get a couple of more quarters of pretty good growth. 3 to 4% maybe, and then we could see a new high for total U.S. output or gross domestic product in 2021 rather than waiting into 2022. Globally, China's rebound is broadening out. Business there is mostly back to normal. Households have really been restrained, but the most recent data a couple of nights ago showed that retail sales are now, I think, 3.3% above a year ago. And China is going to be, I think, the only country that will show total growth or make a new high in their gross domestic output for this year. If we look at Europe, countries are starting to restrict activity there because of the enormous rise in cases. So growth is really slowing a little bit. Nevertheless, Eurozone retail sales are now at an all-time high. So the economy clearly is improving, but it's improving more slowly. Japan is somewhat like that, although they don't have the big rise in cases. Business confidence has come back in Japan, but households there are very restrained. If we look at developing countries, the fundamentals are really quite good. Weaker dollar, super low interest rates, rising commodity prices, and good demand from China. So I think overall, if we look around the world, the recovery from the severe COVID recession is certainly on track. It continues apace, but it does vary by country and by sector, and it also is going to depend on continued containment of virus activity. Now, I want to move on to my third topic, using what I've mentioned so far as kind of a set of parameters for economic growth for the rest of this year and at least early in 2021. Now, these parameters are certainly going to affect the election, but they're not going to change a whole lot, at least in the short term, based on what happens to the election. But, the stock market looks several months ahead, and the election certainly may impact the stock or bond markets. Now, let's look at some alternatives. Now, you all know there are three centers of power in Washington, D.C. There's the White House, and there's the Senate, and the House of Representatives. Now, in the House of Representatives, the Democrats have 232 seats, and the Republicans have 197, and there are a few that are still vacant. Now, in order to take control, the Republicans must gain 21 seats. I really don't think that's very likely given this current climate. So for election scenarios, we're going to assume that the Democrats keep control of the House. Now in the Senate the Democrats, I think, really need 4 seats to take control because Jones in Alabama was elected in a special election 2 years ago. There was a little bit of, excuse me, a little bit of a fluke. So I'm kind of guessing that Jones is going to lose. So the Democrats will need 4. Now, if President Trump is reelected, it's unlikely that the Democrats will flip the Senate because that voting, if you vote for a Republican for president, likely that's going to continue down ballot sometime. So what we really have then, I think, are 3 main election scenarios. One is the status quo with President Trump continuing as president and a Republican Senate. Secondly, with Joe Biden being elected president, but Republican Senate, which would be divided Congress again. And third, a blue wave or a Democrat sweep. Now, there is a possibility, of course, of a contested election, and markets certainly don't like that kind of uncertainty. Now, we did have that in 2000. And if you recall, the stock market peaked somewhere around election day, and then it fell by maybe 10 or 11% into early December on the uncertainty of what was going to come out. And then once the Supreme Court made a decision, if you remember those hanging chads in Florida, then the stock market rallied a fair amount for a few weeks after that. Now, there could be a contested election this time, but I really doubt it's going to last much longer than early December. I think Chief Justice Roberts understands the gravity of the problems that a long contested election would have. So I think some decision will be made by the Supreme Court in early December, and it'll be made in time for the by mid-December, which will be in time for the Electoral College to meet and vote, and that happens on December 14th. Now, that day is set, I think, by the Constitution, and it is the first Monday after the second Wednesday in December. So let's think a bit about what each of these election scenarios might mean for financial markets. Let's start with the status quo. President Trump is reelected with the Republican Senate. Now, one would assume that we'll get continued kind of light regulation and probably the low taxes that we've had so far, that will continue. In 2021, I'm guessing there'll be a likely phase 4 stimulus of some size anyway, and likely a decent infrastructure package. Now, this would mostly be positive for the stock market. It'd certainly be good for profits and good for job growth. But you know, the stock market is already pretty highly valued, so whatever upside there is in that scenario probably would be modest. It may rally in different sectors, so maybe less in growth and tech, and maybe more in sectors that have to do with commodities like materials, industrials, would also help financials, small cap, and value stocks. What about interest rates in the bond market? Well, if we have stronger growth, that suggests we'd have a little higher interest rates, and that at least long-term interest rates, and that certainly would not be good for bond investors. Now, what about a second scenario with former Vice President Biden being elected president, but continuing with divided government? Well, we'll likely get some re-regulation there because the president and the cabinet can make a lot of choices there. But I doubt that the big tax hikes that are being talked about will get through the Republican Senate. There'll likely be a bigger phase 4 stimulus and maybe even a bigger infrastructure spending. And that spending is going to help the economy, but it might be good for different sectors. Probably not be good for energy, healthcare, banks, or insurance. There'll probably be a rotation over to some green energy kinds of things. So there'll likely be a little bit of economic disruption as the economy tries to realign itself to those slightly different priorities. There may also be a real positive, though, in less divisive foreign policy. We might get lower tariffs and maybe less confrontation with China. Still, all of this ought to be mostly positive for the stock market. But as I said, the stock market is still highly valued, so whatever upside there might be is likely going to be modest. What about long-term interest rates here? Well, a little bit of economic disruption from that realignment might slow growth just a bit. So interest rates might stay a little lower for longer, which wouldn't be quite so bad for bond investors. Now, let's look at that third scenario, a blue wave or a Democrat sweep of those three bastions of power in DC. Well, let's think about the economic plan that's been described. And that's $3.5 trillion in net new taxes over 10 years and 7.9 trillion in net new spending over 10 years. Now, there are a lot of taxes there, higher personal tax rates, higher corporate tax rates, higher minimum corporate taxes. There'd be taxes on foreign profits and significantly higher taxes on dividends and capital gains. There may also be some re-regulation a bit of labor markets. We'll probably get a $15 minimum wage, maybe make it a little easier to unionize some companies, may end the right to work laws in some southern states. Now, those tax hikes and re-regulation are surely not good for business, or they're not business friendly anyway, or profit friendly. And the dividends and capital gains taxes will likely detract from long-term stock ownership. So at first blush, one would think this might be negative for the stock market, will likely be in the long run, but I'm talking 1 year or so. But you know, the stock market is really going to like that massive new government spending, and the spending will, frankly, likely happen first, and maybe in the first half of the year of next year. So those taxes may be relegated to the second half, or maybe even to next year. So there could easily be a moderate stock market upside, at least on, say, a 1-year outlook. What about interest rates? Well, those taxes and re-regulation are probably going to slow, and whatever economic realignment comes along with those different priorities might slow the economic growth a little bit, at least initially. So that suggests that interest rates could even stay a little lower for longer. So this might be the best scenario for bond investors, but maybe not by much, because you still get little purchasing power return anyway from owning government bonds. Now, you may have noticed that in all of these three election scenarios, the 1-year outlook or so is not a whole lot different in terms of financial economic impact. Maybe a modest stock market upside and maybe a little higher interest rates, more or less, depending on the scenario. This is because of my fourth topic, and that is that there are some global trends that are going on today that are going to continue regardless of the occupant of the White House. The point is maybe as we wouldn't like to acknowledge, there are global trends that simply transcend US elections. And I can think of several. Well, first of all, coronavirus activity is certainly not going to be impacted by the election. Well, yes, it is true that former Vice President Biden said he would lock the economy down if that's what scientific observers suggested. But lockdowns, I think we're beginning to see as best has postponed the infections rather than prevent it. So, and we do have treatments are improving, and I think hopefully a vaccine is coming. Second trend is, our U.S. problems with China, well, they're not going to go away. Whoever the next president is going to have to confront China on several issues. I mean, we've got Taiwan. The Chinese Air Force has been invading Taiwanese airspace for some time. And the president, Xi, has been talking rather bellicosely about Taiwan. They've certainly tightened up the screws on Hong Kong. And what about intellectual property theft? It seems like every other month or so, there's something in the paper about some people being arrested for sending secrets to China. What about what about the militarization of the South China Sea? President Xi said that would not happen a few years ago, but there are 4 atolls in the South China Sea that have sizable military operations already. And the propaganda campaign here in the United States, some of you may have noticed an occasional ad in the Wall Street Journal or other national newspapers extolling the virtues of China's governance. So those are all, those problems are going to continue. But third, probably most important, is globalization. You know, that's the issue where global companies here in the US or elsewhere would move some of their jobs to China or India to utilize the very low wage workers in those companies. Well, you know, that was fading before the election, and I think it's going to continue to fade, probably faster. Why was it fading? Well, I think you can think of a couple of reasons. One is that China is just not as competitive as it was 20 years ago because of 2 decades of very fast wage growth in China. Secondly, the people whose jobs were lost and went to China, well, they vote and they rebelled at the ballot box. So that's why it, really started in the UK when they decided to get out of the European Union. That may be part of the reason Donald Trump was elected. We also gave us the Five-Star Movement in Italy, gave us Marine Le Pen in France, gave us the Alternative for Deutschland in Germany. So these voters want policies that help people, not policies that help China. Well, the reason I think it may continue to fade, globalization that is because the virus has shown China to be an untrustworthy ally. And it's not just the US, frankly, it's several countries are reassessing their relationships and their supply chains in China. So I think regardless of the White House occupant, their globalization is going to continue to fade, and some jobs anyway are going to exit China. Now, the last global trend I want to look at is fiscal policy. Now, really, since the 1980s, monetary policy has been the main government tool to respond to or to combat recessions. What the Fed would do would be to lower interest rates in order to stimulate consumption and investment. Fiscal policy kind of got a bad rap in the 60s and 70s with stagnant growth and high inflation. Now, however, massive government spending is being combined with really aggressive monetary policy, and this combination is going to continue, I think, under any administration. So I think these global trends will continue. And I think what this suggests is that the overall investment climate of the 2020s may be very different from the investment climate of the last decade. Well, think about the climate of that last decade, say from 2009 to 2019. It was a climate really of fear. Because remember, 2010, 11, 12, people thought, oh gosh, we're going to relapse into a second financial crisis. And there was another financial crisis, remember, in Europe in 2011, 12 or so. Then we had very low inflation, less than 1%. And the Federal Reserve was terrified of deflation. So they kept interest rates at zero for a long time. And then we had very slow growth. Remember, this is the worst, the slowest recovery from a recession in US history. Now, that was a tremendous backdrop for the outperformance of US assets and of the US dollar. I mean, money flowed into the US because we were viewed as a safe haven. I remember people saying, well, it's, the best horse in the glue factory. And a lot of that money went into bonds. So and that interest rates came down, which made enormous returns to US government bonds. This was also then a tremendous environment for growth and tech, because those low interest rates meant that investors were going to discount those huge profits of growth and tech stocks way into the future. So those low discount rates then meant a very high present value. But this decade now is going to be, I think it's going to be a lot different. The fear of crisis, I think, is gone. The dollar is weakening, not strengthening. And I think inflation is not going to stay negligible. I mean, listen, the Fed promises to let the economy run hot, let job growth run hot. Globalization is fading, so the disinflation that was fostered by globalization is going to fade with it. Massive government spending suggests that demand is going to increase more than supply, which is another recipe for at least a little bit of inflation. And faster job growth suggests faster wage growth, which is necessary to get some inflation going. So I believe this decade is going to be characterized by just a bit more inflation. Now, not 5 or 6%, but just say 2.5 or 3 or 3.25, just enough that the consensus that interest rates and inflation are going to stay lower for longer begins to change their expectation. I think if this happens, this is going to mean a much different investment climate for much of the 2020s. What it means is that bond yields are going to need an inflation premium because they certainly don't have any now. I mean, if you buy a 10-year treasury yield today yielding 0.82 or whatever it is this morning, that means you're going to lose maybe 1% in real purchasing power every year for the next 10 years. So that says that bonds are not necessarily going to be a very good investment. Secondly, broad stock market averages may struggle too. That higher discount rate suggests when you discount those future profits back to the present, that suggests a lower present value. And if you have faster wage growth because of less globalization, that means profit growth might be slower too. So, how might you make a return over the rest of this decade if that is maybe what's going to happen? Well, I think there are two ways. One, I think you need to get an active portfolio manager for your stock investments and bet on some stock market rotation. Because I think what we're going to see eventually is that companies that benefit from faster nominal growth, those are the companies that are going to outperform. That means companies that produce commodities like material companies, the materials sector, industrial sector, financials will benefit banks from a little bit higher interest rates, consumer discretionary. These were all the underperformers of the last decade. And you are for sure going to need an active management. And I think, tech and growth are not going to be the winners of the decade through 2020. I mean, if you think back, whenever the case has been that the top 10 companies, top 10 market cap companies of the entire world are mostly in the same sector, that sector just got massacred in the next decade. Think of early 1980. 6 of the top 10 market cap companies were oil companies. How did oil companies fare in the 80s? Oh, it was awful. How about early 1990? Well, 8 of the top 10 companies were Japanese. How did they fare? How did the Japanese fare in the 90s? It was pretty ugly too. Same way with tech stocks early in 2000 or Chinese stocks in 2010. How about today? Well, earlier this year, well, it's probably still true today. 7 of the top 10 market cap companies are in the tech space. Apple, Facebook, Alibaba, Tencent, Amazon, Alphabet, Microsoft. Similarly, I think you should worry whenever area of the world makes up an enormous part of, say, a world index. Like right now, U.S. stocks are 55 to 60% of the MSCI World Index. Early in 1980, energy was about a third of the MSCI index. My point here is that there always seems to be a return to the mean. Why? Well, for very large companies, it's hard for them to grow at 25% a year like small companies can. They become bureaucratic and less innovative and kind of forget what got those companies there in the first place. And then there's government regulation, as we're seeing already. You know, a democracy doesn't seem to like a concentration of power. So secondly, another way that maybe make a bet on this decade, if what I think is a little bit more inflation comes true, is to look at real assets as opposed to financial assets. I'm talking about commercial real estate, housing, farmland, commodities, even emerging market stocks because they sell commodities. This may be a decade somewhat like the 70s where real where financial assets struggle, but real assets surge. Now, even if this is how the decade is going to turn out, it doesn't mean that this investment climate is going to change on a dime next month or even next year, or maybe not even 2022. So what do you do in the intermediate term? Well, I believe I would certainly prefer equities to bonds, at least at the moment, if you're trying to make a choice. But I think whatever you do, caution is certainly warranted through the year end, because we could easily get some election volatility. I do see some at least modest upside for the stock market, as I mentioned, in maybe any kind of election scenario well into 2021. And likely the companies that have outperformed in the past, well, they may continue to outperform through early next year. But I probably wouldn't overweight growth or tech. I'd probably keep a balanced stock market portfolio. And it might be a good idea to even have some emerging markets in there. You know, I think it's not impossible for the Standard & Poor's 500 index to see 3,700 to maybe even 4,000 sometime middle of next year. For bond investors, I'd certainly avoid government bonds. You don't get much real return. I would prefer maybe non-traditional fixed income, like high yield, preferred stock, municipal bonds, maybe even an equity income fund. With two caveats. I'd stick to intermediate term maturities, maybe 2 to 4 years on a bond maturity. And I'd certainly stick to pretty good quality stocks. And then, over the next year or two, I'd keep an eye out for potential change in the investment environment. I think maybe three things could signal that coming change. One is a steepening of the yield curve, meaning that long-term interest rates rise faster than short-term interest rates. And with the Fed funds surely anchored at zero or close to it, probably well into 2022, maybe even 2023, that will likely happen at some point. A second signal, I believe, will be a continuing weakening of the dollar. It's also already weakened some, but I think we'll need a more serious weakening to bring this change in the investment climate that I'm talking about. And then I think we need to see continued rise in commodity prices. I really like commodity index. It was called the CRB Index of Raw Industrials. That's been making new highs since maybe March or April, May, something like that. But Dr. Copper is rising. Oil's been kind of flat, but I think if we get a little more nominal growth, that will start to perk up a little bit. Interesting that agricultural commodities really have perked up a lot in the last couple of months. So I think those three things, when we see them, would be kind of signals that maybe this investment climate is changing. And I summarize just a bit. I do think virus activity is picking up, and that's going to be a real question for the economy, and because December and January are really the peak months of the traditional flu season, and that if we see the coronavirus happen along with that, that would certainly impact the economy. Secondly, I think the global economy right now is well into recovery, with the US and China driving the world economy, but it's going to depend on containing the virus. Near term, I think is probably okay for financial markets, but I'd certainly keep an eye out, as I mentioned, for the potential change in investment climate. Be glad to answer questions. I'd turn it over to, I think Kara was going to handle questions if there are any. So Kara, have at it.
Absolutely. Well, we encourage anyone to add the questions that they have to the chat at this point, and then we'll see what we've got. I know, Bob, you covered a whole lot of really interesting things. So now is the time, while we still have him, for any follow-up questions that anyone has. And it looks like we have our first one right away. Looks like we have a question that says, do you anticipate the pandemic to be a catalyst to fourth industrial revolution, i.e. digital, biological, and physical worlds coming together? Maybe not based on your comments on technology stocks.
Well, we're certainly going to, we're right in the midst of that kind of digital revolution. I'm not sure how you really classify 1, 2, 3, and 4. I mean, the first industrial revolution really started in England in the late 18th century with the invention of the automatic weaving loom. But we're certainly seeing right now a tremendous increase in technology. And, frankly, that's what one could surmise that it really has been technology rather than globalization. I mentioned quite a bit about globalization and how I really thought that was the key to the lower inflation that we've seen in the last decade. But one could make a good case that it was really the technology that brought low inflation. Amazon, for example, made pricing very transparent of all kinds of different goods. Now, with if you hold a phone in your hand, now you have more computing power in your one hand than I think they had when they put a man on the moon in the 1960s. It's just phenomenal, and that continues. And the more technology you have, the more adds to it. So, and also then you combine that, as the questioner asked, with biotechnology. I mean, that's what we're seeing right now. Moderna is using a messenger RNA. That's one of the 3 or 4 potential vaccines. That's been used or been studied a lot for cancer research. The idea there is you send a message to the body's DNA to ward off the invader, whether it's cancer cells or whether it's coronavirus cells. So, I don't know that I'd call it a revolution, but it certainly is. All of this is combining in one big change, and that's just really dynamic. But frankly, we need more of that here in the U.S. and the world because it's interesting. Technology. Remember back when the automatic weaving looms, we had the Luddites. They took a sledgehammer and destroyed the weaving looms because they thought it eliminated jobs. Well, if those people had just learned to read and write, they could learn to repair the weaving looms and have another job. For all the technology we've had over the centuries, in the short run, maybe it might have eliminated a few jobs, but always created far more jobs than were eliminated. So I think the more we have, the better.
Awesome. Thanks, Bob. We've got another one here. Katie Ross says, thank you first off. And she says she always loves hearing what you have to say. And she's got a question about a recession next year. She said in August of 2019, there was a lot of talk about a recession and then it kind of went away. Do you have any worries about a recession next year?
Well, it's interesting. I think in January of this year, for the first time, I had a little economic committee that we make economic forecasts for the principal and for lots of its different business units. And for the first time, I put a recession in the potential forecast for 2021. And that was based on the idea that if you look at economy-wide profits here in the United States, profits have really been flat since about 2015. Now, I don't mean profits on stock exchanges, but total profits across the entire U.S. economy. Now, what that assumed was that we were going to continue to grow, and I thought that lack of profits is certainly a recession signal down the road. So I put it in there as a potential for a base case. However, there's been a lot change since that late December, early January forecast. And what's happened is this COVID recession has maybe helped avoid what might have been a recession next year. Companies right now are taking aggressive action to cut their costs. We had I think a total of 22.8 million people on continuing claims, jobless claims back in May. And companies then used those layoffs to really cut their costs. So we've seen productivity rise very strongly. So at least for companies that are able to continue to exist regardless of the level of interest rates, I think they're cutting costs, and I think that potential for a profit decline into next year is gone. So I see, unless we get a really bad case of the coronavirus back again, and we don't get a vaccine, I think maybe that's about the only way we could kind of have a double dip recession. That is our downside scenario, that we get no vaccine and we get a very serious bout of it through December, January, February. That would give us a double dip recession next year, but I see that as not having a high probability.
Good to know. Thanks for that insight, Bob. We've got some more questions coming in. We have got past chair and city councilman Matt McKinney has a great question. He says, he wants to know if you have any perspective on future business practices, i.e. return to business travel and return to the office versus work from home for the next few years. And he wants to know if there's any potential impact of any long-term changes on those practices to commercial and retail businesses.
Great question. Great question. Like the other two, Matt, I think we're already seeing some changes. I think business travel will probably take a long time to get back to the level that it was. I think we have learned that you can do some things on a virtual level. You can't do all of them. It's very hard to cement a customer relationship virtually without without a handshake and looking directly in the eye. That's how you kind of cement things. So from a client relationship perspective, I think we're going to see some of that. But I think travel is going to be limited. I saw a headline a day or two ago said United Airlines, for example, is battening down the hatches for a long haul. So I think that's certainly going to change. Now, there's a lot of talk about working from home and how we may see an awful lot of offices in city centers have a lot of empty spaces. I think some of that consensus is maybe a little premature. There's no question. I understand there are a couple of large law firms here in Des Moines, I think, are looking for smaller spaces. At least that's the rumor, because you don't really need a big space for a law library. That can be done on the internet from somebody working at home. So there is some of that. But I think it's really hard long term to start a new employee, to oversee employees, to kind of develop a company culture, to develop a camaraderie all on a virtual level. So I guess what I see is maybe kind of like what I've been doing. I was one of the first people to volunteer to come back into the principal offices back in June. But still, I come in maybe 2-3 days a week for part of the day anyway, and work from home the rest of the time. So I'll still need a desk and an office here, and still need custodial services and those kinds of things. So I think the early idea that we're just going to eliminate all these downtown offices, I think that was premature. But it certainly is doing one thing, and that is suggesting that people move out of small city center apartment buildings. We're just seeing housing activity just off the charts. The sales this morning are the biggest since, or that came out this morning for September, are the largest since like 2005 or 6. And there's just, if you look at home builder confidence, as I mentioned, their home sales, building permits, mortgage applications for home purchases, those are well above last year. So we are seeing people want to live more in the suburbs and have a little more space than some of these really small city center apartments. I think some of that is going to continue, but I think they're selective. Right now, for example, in real estate, warehousing is that's the big deal in commercial real estate right now. Office is kind of lackluster. Retail malls are still kind of questionable. But I think a suburban kind of apartment living probably is still good. Hope that answers your question, Matt.
Thank you, Bob. Yeah, that was a great question. We've been talking about that a lot internally as a chamber team as well, what that's going to look like for different industries and businesses in the central Iowa community. So thank you for the question, and thanks, Bob. We've got another question. We would like to know, what are some key sectors that have surprised you that have done well during the pandemic?
Well, it's interesting. Healthcare has not done particularly well. That was a surprise, and that's the opposite of the question. But I think certainly the pandemic has kind of taken over the hospitals in some sense. But what it did, it eliminated all of the voluntary surgery. It kept people who might have gone in for cancer screening. And other kind of normal screenings. I think it's kept those people at home. They were just didn't want to go into the hospital where all of the COVID patients were. So healthcare really was a big underperformer during the decade. Also, I think a surprise to a lot of people was the continuing outperformance of growth and technology stocks, and they have wildly outperformed since March, although maybe not as much as they had in the years prior to that. I think the reason is because the environment of recent months, since we've had this pandemic, is very similar to the kind of investment climate that we had in the 1990s. We've had slow growth. We've had fear of the COVID. We've had super low interest rates. And all of that, the lower the interest rates, I mean, right now we've got long-term treasury yields, the lowest in the, well, actually the Bank of England did a study a few months ago and said they had the lowest long-term interest rates in England since 1275 AD. So how many hundred years is that? And I think the same is true in the United States. We have long-term rates at multi-century lows. So when you have rates that low and you have stocks, like Amazon or Apple or Alphabet, Facebook that have look like what are secure profits and a long-term into the future, then you discount those earnings back to the present value with very low rates. And the lower the discount rate, the higher the present value. So looking back, it probably shouldn't have been a surprise that tech stocks continue to do extremely well. But frankly, I think that trend, at least in the intermediate term, is going to continue.
Awesome. Good to know. And thanks for giving insight on the other end of it too. I think that fits the question very well. We've got another question from Tyson on the line here. He wants to know if you have any opinions about precious metals, cryptocurrencies, and digital currencies over the next decade. He said there seems to be a wide range in opinions on the power the Fed actually has, and also the ultimate effect increased fiscal spending or fiscal policy will have in the short-term boost versus lasting effect.
Well, if you think about, let's kind of divide those up. If you think about precious metals, gold was an early winner in the pandemic because with a huge fiscal spending, there was a lot of thought that inflation might come back at least a little bit. Now, gold has kind of gone into a consolidation for some time. But if I'm right about just a little bit more inflation the rest of this decade, gold probably would be. Yeah, I think some of the upper suggestions by gold companies are a little high, but certainly gold could continue to advance somewhat. Silver could advance along with it. Silver is a more volatile one of the precious metals than gold, and I think it's even had a better outperformance in recent months than gold. They're in a consolidating period right now, just like the dollar has consolidated, and I don't think they're going to rally much more until we see the dollar start to weaken again and make another breakout on the downside. If you think of like Bitcoin and cryptocurrencies, frankly, I would look to China right now because they're making some not so much experiments, but they're doing a study of cryptocurrencies, and they might be the first to have a real digital currency at some point. I've always thought Bitcoin and some of the other cryptocurrencies were more speculative vein, but it's at some point, if currencies, if all these diminish in values, but I'd certainly want to have the standard, like a gold standard, something like that. I'd want to have a little gold in my portfolio. And I think the last part of your question was of the questioner's question was about what would happen with deficits and that kind of stuff. Was that right? Well, certainly, if we look ahead, we've got what, a $3 trillion deficit this year already. So government deficit spending is going to continue to rise, and at some point, that's going to cause a real problem for the Federal Reserve or for interest rates. Back in the 70s. We had something called bond vigilantes. So whenever the money supply soared, then they made interest rates go up by selling bonds. So we had very high interest rates. Now that could happen again. Now, if the Fed tries to prevent that, they could keep long-term interest rates from going up for quite a while. But eventually, there would have to be some kind of restriction on the movement of money across borders if the Fed is going to continue that. So long term, a huge budget deficit like is in prospective for the United States will be a real problem. I don't think that's going to have a lot of impact next year or the year after, but certainly long term. How do you pay off the deficit? There are really only four ways. Number one, you can simply renege and say, well, we're not going to pay it. Well, that's not going to happen, I don't think, in the United States. Secondly, you can say, well, we got to triple the tax rates for everybody and pay it off. Well, that's not going to happen here either. The third thing is you can try to grow out of it, meaning you have government revenue, the income grow faster than spending, which means the economy has to grow faster than the interest rates that you're paying on the debt. Now, we did that successfully in the late 90s. And we ended the 90s with remember the pact between Bill Clinton and the Speaker of the House and Newt Gingrich at the time. They kept government spending growing more slowly than the economy, and we ended the decade with a surplus, at least for part of the deficit. Now, the other way, and probably the most effective way, is to let your currency devalue and you pay it off in cheaper dollars. That's part of the reason I think we'll see a little bit higher interest rates and a weakening dollar.
Good to know. Thank you, Bob. We've got another question from Jake with TPG Companies. And he says universal basic income has gained traction in Iowa primaries as a talking point. He would like to know if economists are looking at how that may play out if enacted, and also wants to know if it is a far off concept, or do the stimulus checks take us a step towards enactment of that model?
Oh, I think the stimulus checks probably have taken us a half step or so toward that model. It was tried a little bit in one or two countries in Europe. Was it Denmark or Sweden? I forget. And it was also tried. Was it tried in California in a city? Yeah, I think it was a medium-sized city in California. They took a small portion of their population and sent them, I don't know, $500 or $1,000 checks a month for maybe a year to see what would happen. Long term, I mean, from a philosophical standpoint, if you pay people to not work, it's just like with the $600 extra unemployment benefit a few months ago. What that did, we had lots of lots of concern among the business community. Maybe you saw it in the West Des Moines Chamber, I'm not sure, of companies that couldn't get their employees to come back because they were making more through unemployment than they would if they came back to work. So paying people to not do something is, at least to me anyway, it doesn't give people the the self the self the not the integrity, but the self-awareness or the good feeling about themselves that working at a job does. So I think that's not really good long term. Can it get us over a problem like the coronavirus? Sure. Long term, I think it would be detrimental for the economy. But we've certainly, as the questioner posed, we've certainly taken at least a half step in that direction.
Awesome. Thanks, Bob. We've got another one that's a multi-part question. So let me know. I'll read all of it from the start and then let me know if you want me to revisit any aspects of it. So question from Rick. He says, while we're seeing home sales increase, what are we seeing in home sales values? And he wants to know, is the market stable or inflated as people move from city centers to suburbs? And then part two, regarding office spaces and warehouses like you talked about, are companies moving FFE into storage and downsizing their spaces? And then he'd also like to know how cities will allow alternative options for these abandoned spaces.
Well, if we look at housing market in the first place, house prices are certainly let's put it this way, the house price increases are getting just a little bigger. Takes a while, but there's so few houses for sale right now that some homes are they're being snapped up within a day or two, or there's even an auction by 2 or 3 people that are willing to buy at the existing price. So I think, yes, home sales volume is huge right now, or back to what it was in the home housing boom of the mid 2000s. House prices, at an all-time high, and they are price increases are continuing to creep a little bit longer. So I think the outlook for housing, at least right now, is really pretty good over the next few years. Now, that was the first question about housing. Second question was about real estate. Was about remind me of that. Was about warehousing was part of it.
Yep, he wants to know, is the market stable or inflated? Oh, nope, that was the previous one. Regarding office space and warehouses, are companies moving FFE into storage and downsizing their spaces? And he wants to know how they will offer alternative options for abandoned spaces.
Okay, we'll go back to the housing thing. The question was, are they inflated? And I guess I don't think they're certainly rising, and I think they're going to continue to rise at a decent rate. But I guess I wouldn't say they're inflated right now. So if we look at real estate, there are certainly companies. I think the office market right now is probably kind of in the doldrums. I think people are just kind of waiting. Both buyers and sellers are waiting a little bit to kind of see how this is going to shake out. And I would guess those doldrums in the office market might continue for a little while. I don't see any companies at the moment, or at least that I've heard of, are closing their offices or putting things into storage. I think it's going to take a little longer to see how what happens to coronavirus activity over the next year or so. I think that's a longer term trend. But we're seeing right now in terms of warehousing, I think Amazon was talking about buying an entire mall and turning the whole thing into a warehouse, or at least buying some of the, buying some of the big box stores where the companies have closed those on some malls and turning the entire mall into a distribution center. So I think that might be why that might be a help for malls, but it's certainly adding to warehousing. Any real estate investment trust with warehousing is just going great guns right now. But I think for companies to make long-term investments in the asset market, it's going to take a little longer to see those. And I think we could see the doldrums in the office market probably continue for a while. I still think there's a piece to that question that I haven't addressed yet.
You covered the abandoned spaces. Rick, was there any follow-up, if you're still on, that you wanted to ask him, or did that answer your questions in full?
Yeah, I think that answered my questions. Thank you for taking the time to respond. Thank you.
Surely.
Okay, next question for you. What do you see as a tipping point for the US economy? Are there any blind spots that we should be aware of, i.e. the dot-com bust, the housing bust? Are there any other potential busts in the near future that we should be aware of that could be concerning?
Well, you know, when we talked about housing, I did mention, you know, there's a move. There are kind of two things going on in the housing market. One is in places like New York, New Jersey, Illinois, at least in Chicago, parts of California, the tax law change was at December 2017 that limited the deduction that homeowners could take for property taxes and some other things. That really has hit the housing market hard in those very large city centers that have high state tax laws. So that's why there's some real problems in New York. I think there's some in Chicago, certainly some in California. So that's a second issue right now about housing. So downtown housing has really got two problems. One is the blue state problem with the limited property tax deductions. And the other is what I've already talked about, of people tending to move out of city centers toward the suburb. Oh, after I did that, I'm sorry. The question, what was that question again? Quick, sorry.
Just about a tipping point for the US economy and any general blind spots.
Yes. In terms of a tipping point for the U.S. economy, I think the biggest problem we have looking ahead is the coronavirus. If we would have a very sharp rise in activity, in virus activity, which would limit even more the return to normal that we're trying to get in the process of now, I think that's the biggest risk at the moment. But of course, there are certainly other peripheral risks. You know, look at what China is doing. They're being very bellicose about Taiwan. And I think one of the secretaries either has already or is going to Taiwan, and that really that made the headlines in China, and they certainly didn't like that. So you know, if China did something really like invade Taiwan, you know, they're a traditional ally. That could be a black swan in the future. I think that's a very low likelihood. But in terms of kind of typical things that cause a recession, which would be lack of profitability, if we get job growth or job growth that's too fast, or wage growth that's too fast, we're just not going to have those things. Those things that typically cause a recession, we're just not going to have those within the next year. So not into 2022. So I think you know, recessions have a job to do. Their job is to kind of you know, their job is to solve the excesses, to limit the problems, and to some extent that recession has done this. I think it's kind of solving the profit problem, and while there are going to be some permanently unemployed people from this, it's very interesting that there's an interesting new series from the Census Bureau that shows the requests for employee identification numbers, which is what you get when you start a new business. You need an EIN number. That request is like triple what it was a year ago. So maybe some of these unemployed people that had very high savings from those $1,200 checks, there seem to be many of them that are starting a new business. So that's really a positive thing for growth. So I just have to admit, I'm just fairly optimistic about economic growth over the next year or two or three.
Good to know. Thank you. We've got, I believe, one more follow-up question, and this ties back to housing. Cliff with Sandler Training would like to know, he says many real estate investors feel there will be a housing crash in 2021 due to income instability from the loss of jobs that we've seen during COVID. He says that companies from the pandemic, he says the number of households currently in forbearance was 8.3% in July. And he said during the 2010 recession, it was just over 12%. So is there anything to be concerned about there as far as a housing crash in 2021, 2022, and the near future?
Well, I think those problems with the housing market that he quoted are certainly due to the coronavirus. And I think as we kind of get back to normal, some of those concerns will go away. Now, if you look at really what the root of a housing crisis is, that's got to be high interest rates. If we look back to 2008, what people were doing there, or 2004, 5, and 6, they were borrowing money, cashing out some of the appraisal value of their home and using it to take a vacation or spend the goods. We're certainly not doing that now. And with mortgage rates really at right next to all-time lows, interest rates are certainly not going to be a problem for the housing market. Then further, if you look at the household's savings rate right now, it's like 14 or 15%, which is almost double what it's ever been. Part of that, of course, is from the stimulus checks, but I think we're going to get another set of stimulus checks either after the election or after the inauguration. So that savings rate is going to continue to be very strong. Then further, if you look at the household debt has continued to come down. If you look at the different ingredients in debt, credit card debt has risen some, auto debt has risen a little bit, but total household debt has continued to come down as a percent of GDP because real estate debt has continued to fall. And the amount, the percent of a household's income that it takes to pay off, to make monthly payments on its debt is right now at a record low. So it's just the main rising interest rates, too much household debt, too much real estate debt. Those things were all behind the financial crisis and the housing bust that was caused or that came about in 2007, 8, and 9. I just don't see any of those fundamental things as a problem. Certainly not for next year and probably not for a few years after.
Awesome. Well, happy to hear. Thank you, Bob, for all your insights from start to finish. Amazing questions. Thanks for everyone who put those in the chat. And I will go ahead and hand things back off to Catherine.
Thank you so much. This has been so insightful. I don't think my pen wrote fast enough, but I'm so happy we recorded this because Bob, you are amazing. And all the stats that you just have in your head is incredible. And you have to update those stats every single day because they change every day. So you're just so impressive. What a dynamo. Amazing, amazing. Thank you for the information. And it's actually really interesting to hear the move from the cities to, and that's what Des Moines is, a beautiful, beautiful place. So that's a great, we can all really certainly appreciate right here on this call. I want to say thanks to Matt McKinney, our honorable city councilman, for being here today. And I wanted to recognize you, Matt. Thank you so much for taking the time and doing all that you do to help our city stay strong. And I know you put lots and lots of extra hours in on behalf of our community. So wanted to recognize that you are here today. And I also wanted to recognize Chris Nelson, our board chair of the West Des Moines Chamber. And thank you so much, Chris, for being here and appreciate it. Do you have any closing thoughts, Chris, for us? I know you've been soaking this all in, so.
I have been typing away, which is last year I looked at my notes with Bob and it was, I was writing frantically. We were at Des Moines Golf and Country Club. It was a whole different environment then, wasn't it? It was October 23rd and as I look back at some of my notes, some of them didn't even make sense. I just couldn't keep up with them. This year, I'm going to look at my notes right away here and fill in the blanks because there's a lot of good stuff. And Catherine, you said it was being recorded?
Yes.
So we will have access to that. That might be a whole lot easier than filling in the gaps. Thank you to the staff. Thank you very much, Kara. Thank you for the everybody who's attending today. I really appreciate that. I think the Chamber tries to bring you things that are relevant, and every year this is such a well-attended event to have Bob Baur here. So thank you, everyone.
Thank you so much, Chris. And it looks like our economy is going to be positive. We're going to have positive economic growth. So that is terrific. I mean, that's the best news I have heard in a long time. So really fabulous. Again, we want to thank our presenting sponsor, DG Medical Developers, for being here and helping to support this event. Thank you so much. Thank you to supporting sponsor Unite Private Networks, and then to Principal Midwest Business Center for bringing us Bob Baur. He is an incredible speaker that I know we've grown to love year after year. You know, our vision for West Des Moines is we want to make West Des Moines the best suburban city in America to live, work, and play. And everything we do at the Chamber is around those pillars. And each of us, each of our team members work so hard. So I just want to thank our Chamber team. We do have some very interesting upcoming programming. Mark your calendar, November 12. Gary Barta will be on the line. And then we're doing a holiday open house at the Chamber. Stop by all day long, December 8th. It's going to be a very festive day. So we hope you stop by. Also, a reminder, visit our homepage and vote for the U.S. Cellular Best of the West Awards. Voting ends tomorrow at noon. Make sure you cast your vote today and tomorrow. 1 vote per person per computer. So help us spread the word about the Chamber. You know what's interesting is 30% of our members are not even in West Des Moines. We found that fascinating when Nicole Langmaid did some data analytics for us recently. So many people are seeing the value of the Chamber and help us spread the word. I want to say thank you so much for being here today. We wish everybody a happy rest of the week. And we always like to say, stay positive, but test negative. So thank you.